Good morning from our global headquarters in New York City. I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda. The tariff dial gets turned up again. A federal appeals court blocks a ruling that had put President Trump's tariffs on hold. Meanwhile, stalling talks, Treasury Secretary Scott Bessent says trade negotiations between the U.S. and China are slowing. And President Trump's proposal on a tax bill alarms Wall Street with increased tax rates for foreign investors. Well, you've made it to Friday. You've made it to the last trading day of the month. We are on track for the best month since November of 2023. We're a little bit softer this morning. Doesn't help. We're going to get some of those month-end rebalancing trades, most likely out of equities into bonds. And to that note, one of the worst week for equity flows for this year. That's according to the latest Bank of America survey. So we're softer this morning, down by about 0.2% for the S&P and NASDAQ. It was a bond market rally yesterday. The weaker economic data certainly didn't help, or at least it did help the bond market. At the same time, a solid auction. We take a pause, and now we're higher by about 1.5 basis points on your 10-year yield, trading at 4.43 this morning. Those are your overall markets. Let's get you some stocks on the move pre-market. With that is Bloomberg's Joe Easton. Good morning, Joe.
Morning, Danny. So one sector looking really red today is the retail, clothing retail in particular. We've got Gap down around 15% in the pre-market this morning, and also American Eagle edging lower as well. Gap missed on its earnings, and also a bit of disappointment around the impact of tariffs on the company. Banana Republic, I'm told, is the weak one there. And as I say, American Eagle adding to the negativity in that space today. Then over in pharmaceuticals, this one stood out to me. Regeneron down sharply, a drug that they've produced with the French company Sanofi to treat former smokers that have a lung illness, has actually missed expectations significantly. It was supposed to be a blockbuster drug, but Regeneron stock down 12% in the pre-market. Sanofi down around 6% as well. And then finally, back in the beauty and cosmetics space, Ulta Beauty, this one sharply higher on better than expected earnings per share. I'm becoming a bit of an expert on cosmetics following the Elf and Hailey Bieber story yesterday, Danny, but that one edging higher, and as usual, all of this on the Before the Bell opening wrap this morning.
I was going to say, Joe, 2 days in a row covering beauty stocks. It's wonderful.
It's my new specialism. I'm all about it.
Joe Easton, our cosmetics and beauty reporter there. Thank you so much. We'll catch up with you later in the hour. And in just a few moments, we'll also speak with Wei Li of BlackRock, who will give us the market latest as tariff developments continue on. And later, Cayla Seder from State Street will be joining me as a guest host. Now, it's been quite the month. A lot of back and forth on tariffs, even in just the past week. Would you be surprised if I told you then that this is the best month for the S&P 500 since November of 2023? There you go. We're higher by 6%. It's also the first monthly gain after 3 months of declines. Joining us now is Wei Li, Chief Investment Strategist at BlackRock. Wei, I got to ask you, with all the volatility, would you be a buyer at these levels? We're looking at valuation still for the S&P, something around 21 times.
Hey there, good morning. Happy Friday. Thanks for having me. As you know, Danny, we have been overweight U.S. equities when it was clear that there were constraints shaping policy making and shaping kind of the negotiations on tariffs. So that's immediately after the April 9th pause of 90 days. So our framing of navigating this period of uncertainty seems to be holding, which is, number one, do not try to predict the next step of policy making. That is impossible. Do not try to predict the next headlines. That is impossible. Number two, really focus on immutable laws that we know will hold, will have to hold, even at times like this, that can govern how quickly things can progress, things can change from status quo. So the immutable laws that we have identified include U.S. debt arithmetic and how that sits alongside the attempt to close trade deficit. Another immutable law is around how quickly we can unwind global supply chain that took decades to build. And because we have these immutable laws governing our framework of risk-taking, even though policy is very uncertainty is very elevated, we were able to stay risk-on through this period of unpredictable policy making.
Can we talk more about the global supply chain unwind, Wei? Because that's a really interesting one, and it's a very long-term one, and it's hard to wrap your head around. If the U.S. trade balance is reshaped, if less people come into the U.S. because maybe they're less attracted to it, the U.S. tries to ring fence a moat around its own businesses. How are you thinking about the long term, what this ends up looking like?
The longer term is highly uncertain. That's stating the obvious, but the less obvious thing to say is that there is a limit to how quickly things can change in the very near term. So the one immutable law that we stuck to is that supply chains cannot be unwound from one day to the next without grave consequences to not just what it means for inflation, but what it means for having things on the shelf, having critical access to critical goods, which is why we were able to deploy risk, even though it was looking highly uncertain in terms of where global supply chain could be heading towards in the future. One thing I would say though, because of this frame of longer term, highly uncertain, near term, there's a limit to how quickly things can change from status quo. This is actually one of the best investment / trading environment our investors are telling me that they are enjoying. Markets can get carried away with a narrative from one day to the next. On some days, we're talking about tariffs really upending decades of global order. On other days, we have polls that makes people believe or markets believe that maybe we're going back to where things were. The reality is likely going to be somewhere in the middle. And if markets get carried away with one narrative, to the extreme, that's a momentum that we can fade, which is why so far this year, we look at strategies that have worked, active strategies that have worked, reversal strategies have worked. We don't know where things are going to head towards in the longer term, but there is limit to how quickly things can change in the near term. Reversal strategy, fading extreme pricing has been a good strategy that allow our investors to really take advantage of this really good investing and trading environment.
That's so interesting that it's been a good environment, because I don't know how fun it's been to trade in it, but it certainly has given opportunities. Wait, what about international investors? Especially a lot of attention being paid yesterday and this morning to Section 899 of the Big Beautiful Bill, which could impose taxes to foreign investors in the U.S. This idea being that it gives yet another reason for capital maybe to stay at home if you were looking at moving it into the U.S. Are BlackRock clients second guessing parking money in the United States and American assets?
I would say there has been some repricing of American assets, in particular, term premium for U.S. Treasuries and the dollar. And I think we need to normalize the normalization of repricing. What is not normal is term premium in the U.S. staying in the negative territory for such a long time. What is not normal is how strong dollar has been versus fundamentals such as real rate differentials. So in the past, we have seen term premium at a 1%, 1.5%, without international investor community questioning the safe haven status of the of treasuries. In the past, we have seen dollar re-rating and derating to the tune of 20, 25% without international community questioning the reserve status of the dollar. I think we really need to kind of differentiate the sensational headline of the U.S. status of safe haven and reserve currency being challenged and the end of U.S. exceptionalism. We need to differentiate what's happening from that and also just fundamental re-rating, which we have been saying for a while, that term premium needs to go higher to reflect the fiscal reality of U.S. debt. The last thing I would say, what's going on in terms of the court ruling and uncertainty around tariffs, it has been talked about as something that is adding to uncertainty, but is it really adding to uncertainty if the counterfactual is not having legal constraint on chaotic negotiations, right? So what we're learning is that there could be additional constraint, and these constraints may not survive, and there may be ways around them, but perhaps it's not more uncertainty. It's checks and balances and potential constraints playing out, and having that in mind and having a clear framework of how to take risk at times of uncertainty is what we are focusing on right now in terms of portfolio positioning.
Wait, so fascinating. Thank you so much for spending your Friday morning with us. We always appreciate it. Wei Li of BlackRock. Now let's get you some other top stories that are trending on the terminal this morning. A Bloomberg survey sees the ECB lowering interest rates 2 more times this year. Respondents predicted quarter-point reductions in June and September meetings. Economists who were surveyed did warn that the central bank shouldn't wait too long because it could signal that the easing campaign is over. The Trump administration's move to revoke visas for Chinese students is causing many to rethink education options. A Shanghai-based consultancy says at least 30% of clients have canceled plans to study in the U.S. or are applying to countries like Australia, the U.K., and Singapore instead. Now, watch enthusiasts have snapped up used Rolex and Patek Philippe timepieces at the end of April. Watch dealer Subdial saw an 160% higher than normal trading spike after people received their paychecks. It's far above the average 112% bump experienced on the other past days of paydays over the past year. Now, coming up, Treasury Secretary Bessent calls for a Trump-Xi call. We'll have more on the latest trade negotiations and what's stalling. That's coming up next on your Bloomberg Brief.
Earnings season is here.
Earnings, the hot topic of conversation.
It's going to be a lot of fireworks.
Pretty astonishing moment in time in the earnings context.
Bloomberg is first to break the numbers.
Goldman Sachs, JP Morgan, Morgan Stanley.
Booking, Airbnb.
Meta, Microsoft, Qualcomm.
There's a lot to talk about here.
With the smartest insights.
We're not seeing dramatic weakness.
It has been an incredible period of time from a trading perspective.
We feel really good about the market share trajectory.
Continuing coverage on Bloomberg. Context changes everything.
I would say that they are a bit stalled. I believe that we will be having more talks with them in the next few weeks, and I believe we may at some point have a call between the president and party chair Xi.
U.S. Treasury Secretary Scott Bessent speaking there as President Trump's global tariffs come back into effect for now with the latest court ruling for the latest on tensions in trade in China. Bloomberg executive editor for Greater China, John Liu, joins us this evening for him, this morning for us. John, thank you so much for joining us. What do we think it means that trade talks stalled? Where do they stand to our understanding?
Well, it's been 3 weeks since the United States and China came to that pause in Geneva. I think that pause caught everybody by surprise. It was more than a lot of people were expecting. I think it set the bar really high. And as a result, people were expecting a quick shuttle back and forth, talks happening all the time. Chinese delegations going to D.C., American delegations come to Beijing, and none of that has happened. And I think that is actually the reality of trade talks. They're very complicated. The stakes are extremely high. What's made it even more difficult is what you talked about earlier, Secretary Rubio talking about cracking down on Chinese student visas to the U.S. We have the U.S. Imposing new rules on semiconductor design software. We have the U.S. also imposing restrictions or warning other countries against using Huawei chips. All of that has made it more difficult for the Chinese to strike a deal because domestically they have to show that they are not kowtowing, kneeling to American pressure.
One of the interesting things, though, John, we had another circumstance where the White House was saying that talks were stalling or at least slow moving. And that was with the EU. And in response to that, Trump threatened 50% tariffs and then walked it back. But here we have another circumstance of talks stalling. But that threat isn't on the table. Do we have any understanding as to why the way the U.S. treats China is different than its trading partner in the EU, for example?
Well, I think in the example of the EU, you had in quick succession, a call from the president of the European Union and then a pause or a pushing back, a delaying of that 50% tariff threat. As Secretary Scott Bessent might want a call between President Trump and President Xi, but the Chinese are not going to have that call until they know they have a deal on the table that both sides have agreed and everybody's on board and they're ready to sign. Before that, I think it's extremely unlikely that Xi Jinping is going to speak to Donald Trump on the phone.
Well, meanwhile, we have the back and forths in the U.S. court system. First, trade court invalidating Trump's tariffs put in through IEEPA, and then a pause in that ruling until that's figured out. I believe there's a June 9th deadline to start filing the briefs for it. John, how does that change China's negotiating stance, knowing that there's been a lot of volatility in the court system and the viewed legality of Trump's tariffs?
I think it just adds to the sense here in Beijing that they should wait. They can wait the U.S. out for a better deal. And as long as these questions are in the courts, as long as it's not clear whether President Trump has the authority under IEEPA to impose those tariffs, Beijing's going to want to wait and see and try to hold on to its cards and get the best deal it can get.
Well, we'll see if the weekend brings anything new. John, thank you so much for joining us. As always, Bloomberg's John Liu. Now, coming up, one measure in President Trump's proposed tax bill alarms Wall Street. We'll have more on that coming up next and why it might mean foreigner capital flight. This is Bloomberg. It's your Bloomberg Brief. I'm Danny Berger in New York. Now on this Friday, let's take a look at what is on the front pages and headlines around the world. The Wall Street Journal leading with their reporting that President Trump's trade team is preparing a plan B for tariffs. The administration is said to be considering a stopgap effort, which includes language for allowing tariffs of up to 15% for 150 days to address trade imbalances. It's a never-before-used strategy, and it's from a provision of the Trade Act of 1974. Next up, the New York Times leading with businesses feeling uncertain due to the changing tariff rulings. It's particularly hard on industries that place orders for entire seasons ahead of time. Now, most suggested that lower tariffs were beneficial. The court's ruling and its appeal by Trump administration, though, just throwing their planning into further chaos. And on the Washington Post, experts pointing out that Make America Healthy Again, a report that had citations from research done through AI. This had resulted in numerous garbled scientific references and invented studies. Of the 522 footnotes of scientific research in a report sent to the Washington Post, at least 37 appeared multiple times, with others citations including the wrong author. Now, elsewhere in Washington, D.C., buried deep in the 1,000-page document of President's Big Beautiful Bill is an obscure tax measure that started to set off alarms on Wall Street. Joining us now is Bloomberg senior editor Bill Ferries. And Bill, we were just talking about during the commercial break. I mean, this has been in the tax bill for some time. Interesting that it's only now just bubbling up to the surface. What exactly is the concern?
Yeah, so this is what they're calling Section 899 of that tax legislation that passed the House that's awaiting some Senate action right now. It would basically give the U.S. power to raise tax rates on individuals and on companies that have investments in the U.S., but which are based in countries that the U.S. determines have unfair tax policies. So one thing that gets cited quite a bit are countries with the digital services tax, such as the EU and Canada, that the U.S. is opposed to, that this administration is opposed to. It would basically allow the U.S. to raise taxes on passive revenue that people and companies from those countries earn in the United States. So it's a pretty powerful tool, and what obviously the investors themselves are concerned about where this might go. But the bigger question here, too, is we've seen a weakening of the dollar. We've seen this look for other currencies. That is something, we've seen the increase in bond yields. That's something that some analysts say could continue if you're going to put a higher tax on foreign investors interested in being in the United States.
Yeah, it's something George Savelis of Deutsche Bank flagged yesterday, saying that it could change things from a trade war into a capital war. Bill, while we have you, it might be worthwhile just to do a postmortem of Musk's time in D.C. Trump putting on Truth Social that he's planning a press conference with Elon Musk today. Where do we stand on Doge's efforts, and what's the future of it if Elon Musk is going back to his companies?
Well, it's been a whirlwind 4 months since the president took office, and that crew from Doge really got to work right away. They dismantled the U.S. Agency for International Development. They worked across a number of agencies to help pressure people into retiring early or into agencies, into laying people off. The goals have really shifted as this process continued. At one point, Elon Musk was talking about saving American taxpayers more than $1 trillion over time. That has been scaled back quite a bit. I think the Doge website now talks about perhaps $150 billion, but not all of that is really well accounted for. There's been a lot more talk about tensions between Elon Musk and Donald Trump, and also between Musk and different top officials, top aides in the federal government. So I think what we may be seeing here is an attempt to keep Donald Trump and Elon Musk in their own good graces with each other. In the end, even though Musk says he's pulling away from politics, he has obviously an enormous bank account and an ability to write checks for the Republican Party in the midterm elections and in the 2028 elections. I think Republicans, even if they've had gripes with Musk and how he's gone about his business, they want to keep him on their team, especially when it comes time to be running for election again.
Hey, Bill, thank you so much for that rundown. Please enjoy the rest of your Friday and your weekend. That's Bill Ferries there. Coming up, joining us around the desk, State Street's Cayla Seder will be joining us. This is your Bloomberg Brief. From our global headquarters in New York, welcome to Bloomberg Brief. I'm Danny Berger. Let's set your agenda. The tariff dial gets turned up again. A federal appeals court blocks a ruling that has put President Trump's tariffs on hold. Stalling talks, Treasury Secretary Scott Bessent says trade negotiations between the U.S. and China are slowing. And President Trump's proposed tax bill alarms Wall Street with increased tax rates for foreign investors. Well, not only did you make it to Friday, you made it to the last trading day of the month. Perhaps we're seeing trade rebalances going on as we head to the end of the month, but it's also a court ruling back and forth on trade. It's also a Wall Street Journal story about a plan B for tariffs and China talk stalling, all that resulting in slightly weaker S&P 500 futures this morning, down about 0.1%. Bonds did get a bid yesterday, a solid auction and weaker data. The front end stays pinned at 393 this morning. And meanwhile, little movement in both your 10-year and 30-year yields. Let's get some stocks on the move this morning. With that, back with us is Bloomberg's Joe Easton. Hey, Joe.
Hey, Danny. So we've got a bit of breaking news this morning on Palantir. A story in the New York Times pushing this stock higher in the pre-market, trading up around 1% at the moment. The story saying that the company potentially working closer with the US government on sharing data across agencies. So they're talking about the IRS and about other agencies within the government, potentially part of that push by Trump to get more data on the US citizens and across those departments in general. Around 100 million payment reported in that report. We'll have to wait for a response from Palantir. But a bit of breaking news shaking up the movers this morning. Then, in terms of retail, it's looking pretty bad for Gap and also American Eagle. Gap citing some concern around tariffs in their guidance last night and actually missing pretty significantly across their sales. I'm told that Banana Republic, the weak spot in terms of the brands on that one. Also American Eagle just disappointing some of the top ends of the guidance for both of those. So expect them to be a bit weaker in the pre-market today. Then finally, we've got a drug story. Regeneron, this one hit hard. Some disappointing drug data. It was a product that they made with the French company Sanofi on a lung illness in former smokers. And that stock sliding. We're down 12%, adding to the red that we are seeing in the retail space. Retail and pharma probably the weak spots today in the pre-market. Those are the movers for you, Danny.
Hey, Joe, really appreciate it. Joe Easton, enjoy your weekend. Now, we also have a lot of data out today amid all those earnings. Could it rekindle fears over U.S. growth? Here's what we got about 3 hours. April's PCE numbers. Bloomberg Economics expects a soft print and says it's the kind of disinflation that could come from weakening economic activity. Joining us now is Bloomberg NLive's Ven Ram. Ven, what are we expecting today, and how instructive will it be even for today's current environment with the trade back and forth?
Well, I think it'll be instructive if the numbers are to the higher side. Let me just put that in context. So the core PCE, the markets are expecting a print of 0.1% from a month earlier, which I think will equate to an annual increase of 2.5%. Now, if that number prints along the forecast lines, that will be the mildest since 2021, when prices started ticking steadily higher. So the markets would prima facie welcome that. But, a dovish surprise is not going to move the needle much for the markets, as you suggest, because, that is what is expected. But however, a higher than forecast print will kindle the market's worst fears that, look, the tariff and the drama on tariffs is already holding up shipments to the US and leading to empty shelves and the scenario of higher inflation as a result, which is why I think that a higher number today will lead to a Treasury sell-off, mild sell-off. You will see the 10-year yield go back towards that recent perch of 4.5%. Now, interestingly, Danny, if you look at the 1-year zero coupon inflation swaps, they're expecting inflation to be 3.2%. So that 2.5% number is not going to really matter that much unless it shoots higher. If it shoots higher, then the 1-year zero coupon inflation swaps will price higher than 3.2%, which would be a very hawkish outcome for the markets.
Hey, Ven, thank you very much for breaking that down. That is Bloomberg MLive's Ven Ram. I'm pleased to say that joining me now is Cayla Seder, macro multi-asset strategist at State Street. Cayla, wonderful to see you this morning.
Thanks so much for having me.
How much are you going to care about the data? How instructive will it be for you?
I think what I'm interested most in the data that we get today is looking at personal income and personal spending, just to get a sense of how the consumer is faring. Because really, from our view, the consumer still looks okay in aggregate, and it's really, I think it's hard to bet against the consumer, and we see that again and again, but it's also really important to, monitor that and make sure that they're not weakening too much.
So when you look at some of the retailer earnings, just on that port, our reporter Joe Easton was just talking about some of the weakness at Gap, but at the same time you have Walmart holding up. Do you look at these and say these are individual companies that are struggling because of idiosyncratic issues? Or does it say something wider? Because we are getting a lot of warnings from various consumer companies that softness may be on the way.
I think one thing to consider too is how much pricing power they have. So not so much on for these companies, not so much thinking about how weak or strong the consumer is, but how much pricing power these companies have. Because if you think about the supply chain, retailers are at the end of the supply chain. So what we see now is signs that producers are passing on these price increases to retailers, and it's up to the retailer whether or not they can increase prices. And so, that was one thing that was really interesting in Walmart earnings, is that we heard signs that, hey, prices have to increase.
They have to increase, but yet we are still trading at 21 times on the S&P 500. Valuations are pretty rich, especially if you assume there's going to be some multiple compression to come. Are we fairly priced right here?
I think it depends on the sector. And so when we look overall, when we think about especially tech, right? One thing that's interesting is, multiples are high, but maybe not quite as high as they were at peak. So to me, that says, yes, there's an overall multiple concern, but there could still be room to rise. I think the thing to consider is if we start to see signs of liquidity issues and signs of perhaps credit weakness, that could really pop that multiple issue. But for now, we're cautious,
right?
But we might not be at peak just yet.
Right, and I know you wrote this in your notes, this idea that in past periods of dislocation, it's credit that leads the way. This time, it hasn't been that. That credit has been quite more stable. What do you make of that? What could cause finally some real spread widening? We got it a bit, but then money rushed in pretty quickly to tighten it again.
One thing I'm thinking about heading out further into the summer is what happens with the reconciliation bill, what happens when the debt ceiling, and when TGA has to be replenished. Ultimately, that could mean that there's less bank reserves in the system, and then that could put more of a risk on overall liquidity. But we're not there yet. It's still a couple of months out, potentially, but that could be something to watch later in the summer.
How much are you watching foreign flows? I know for some reason the tax bill has been out for a bit, and we're now only just getting worried about, I think it's Section 899 of the big, beautiful bill that could tax foreign investments in the U.S. This idea, just another reason not to put foreign capital in the U.S. Is this a real concern?
I think it depends on what part of the market you're looking at. So, for example, American companies, in our data, we still see a lot of foreign demand for U.S. equities. And so I think, that speaks to the profitability of American companies, and it speaks to how wide those profit margins are. Again, a lot of that has to do with higher quality metrics. A lot of that has to do with, places like tech and things like that. But I think for the most part, on the company side of things, on the equity side of things, we're still okay. Obviously, the bond market, I think, is what has been under pressure recently and where a lot of focus has been in terms of overall demand.
Why hasn't that pressure, though, trickled into the equity market? Because we've seen that before, that higher yields will pressure especially longer duration type equities. It hasn't really played out this time.
Yeah, I think there's a couple things that come to mind with that. One is positioning. So, at the start of the year, very overweight U.S. equities, we started to see shifts away from the U.S. and more so into Europe. Now, as there's more, I would say, caution out there, when we saw higher bouts of volatility, what that means is investors are going to look for quality. And when you look at quality metrics, it's still the U.S. that holds up in a far superior position relative to their peers.
It is a strange moment, though, in long-term bonds. You have higher yields in Japan, in the UK, in the US, too. Is there a rethink in just asset allocation at this moment? That usually the staid part of the market has been very volatile, that treasuries maybe aren't the risk-free asset that they once were?
I think an interesting way to think about this is looking at the curve, looking at, where do we expect inflation to go? When do we think the Fed could cut next? And what, our conclusion right now is stick to the front end of the curve. Cash is still pretty attractive. The front end of the curve is still inverted. And so, if you are looking for safety or less risk, the front end is still very attractive here. And so when we look at our data, looking specifically at more longer term institutional investors, what we've seen is consistent increases in allocation to cash and not so much in the fixed income sovereign space.
Interesting. Cayla, I'm pleased to say that you're going to be with us for the whole half hour. That's Cayla Seder of State Street staying with us. I want to quickly get you some other stories that are trending on the terminal this morning. A Bloomberg survey sees the ECB lowering interest rates 2 more times. Respondents predict quarter-point reductions at the June and September meetings. Economists who were surveyed did warn that the central bank shouldn't wait too long because it could signal that the easing campaign is over. The Trump administration's move to revoke visas for Chinese students is causing many to rethink education options. A Shanghai-based consultancy says at least 30% of clients have canceled plans to study in the U.S. or are applying to countries like Australia, the U.K., or Singapore instead. Elsewhere, watch enthusiasts snapped up Rolex and Patek Philippe timepieces, if I can get my words together, at the end of April. Watch dealer Subdial saw an 160% higher than normal trading spike after people got their paychecks. That's above the average 112% bump seen on paydays in the past year. Coming up, on again, off again, President Trump's tariff bounce around the courts. We'll bring you the latest. That's coming up next on your Bloomberg Brief. This is Bloomberg Brief, and you're looking live at the Principal Room. Coming up later today, an interview with Gap CEO Richard Dixon. That's at 10 a.m. in New York, 3 p.m. in London. This is Bloomberg.
He wanted to use the sweeping powers of IEEPA. Now, he has many, many other laws and authorities that he can use, and he'll take them out if he needs to. But right now, he likes the sweeping authority because it lets him deal with everybody who treats us unfairly. As you know, we're going to go through the courts, and you should always bet on Donald Trump, because what we've all seen is he does not lose.
U.S. Commerce Secretary Howard Lutnick speaking there on the administration's confidence in defending its tariff regime from legal challenges. President Trump did win a temporary reprieve from a block imposed on them by the U.S. Court of International Trade. For more, joining us is Bloomberg News Desk Managing Editor Adam Blenford and Cayla Seder of State Street still with us as well. Adam, great to see you. What now?
Good morning. Well, what now is the question on everybody's lips. We're into a bit of a phase of judicial and legalistic ping pong, perhaps. We've had, as you say, the ruling from the Court of International Trade. That was stayed last night, yesterday afternoon in the US. So the administration's trade policies we're in a kind of it's one of those confusing phases where, they've been put on pause, but then the pause has been put on pause. So we're waiting for the verdict to see whether those policies will actually be able to go ahead. If indeed the appeals court backs up the trade court, the Trump administration will most likely look, it seems, for a series of other measures that it might be able to use to effectively raise the US effective tariff rate and try to change the trade policy it has with its international partners. As you saw there, Commerce Secretary Howard Lutnick was talking quite bullishly about all of those options that it might have available. And Peter Navarro said yesterday, in fact, the US trade expert, that the administration doesn't really consider having a plan B. They just have plan A, maybe of which there are various different strands to it. Gets a bit complicated as you go down into whether they would start to try and investigate under Section 232 or some of the other aspects of trade law that they could use. But they do prefer to try and win out, even if necessary, through the US Supreme Court, which could happen quite soon if they expedite that process, to try and make those initial sweeping powers that the administration used. They want to get those through, and we'll see which way the courts rule.
Hey, Adam, in terms of how many options the Trump administration has in terms of passing these tariffs, do you think, there seems to be some laws that allow the administration to pass tariffs more specific to sectors, and then there are other laws that allow the administration to focus on countries. Do you have a sense, does this mean a pivot and more of a focus towards sectors, or will the focus remain on overall countrywide tariffs?
It's complicated and a little difficult, as we say, to predict what the administration is going to do. But it does seem that one of the options that they could have, that they've used in the past, is this Section 232 of the Trade Expansion Act. That's one of the pieces of legislation. They've used that in the past, I think, to investigate and to work with steel tariffs on China. But they require significant and lengthy investigations. There's an example where the track that they went down in April, using the IEPA to try and unveil sweeping tariffs across all different jurisdictions at the same time. That's obviously, while incredibly complicated for the markets and for the business world to navigate, as well as foreign governments negotiating with the US, it's a clearer path than complex, from the US perspective anyway, it's a clearer path than complex individual sector-by-sector deals which would require specific pieces of work. But that may be where they're going to. Peter Navarro was talking yesterday about Section 301 powers and Section 232 powers, so that those have been used in the past.
So do you think this changes how permanent the tariffs could be? I think it's hard for companies to manage tariffs if they think, they could be on for 5 years, if they're permanent, if they're just the remainder of Trump's administration, or if they could just be here for a couple of months, or, the outlook really shifts. Do you have a sense of how long tariffs could last, and perhaps, how they're applied and what legal precedents Trump uses? How does that affect the duration of tariffs?
Companies and markets and governments are going to have to, as they have been in recent years, make allowances for high degrees of uncertainty. There's no clarity at this point as we approach. We're April and May. We're 2 months into this cycle since the so-called Liberation Day tariffs were unveiled, and we're approaching a kind of peak import season with lots of goods leaving Asia, heading towards the US. And there's not really any clarity, despite some of the ups and downs and the pauses with China. A huge amount of clarity for businesses around what kind of tariffs they might face right now, let alone in as you say, 6 months, 2 years, 5 years' time. Uncertainty in markets and business definitely seems to be the watchword of the moment. International governments, we see some talk that there is still negotiations ongoing with, for example, Japan at the moment. We've seen the UK conclude at least the very outline of beginnings of a trade deal with the United States in recent times. The EU is continuing in some way to negotiate with the US government, even against the backdrop of all of these changes and court rulings. We saw a post on X this morning from its trade representative, Maros Sefcovic, saying that they've just held talks yesterday. So there's plenty going on, but there's a lot of uncertainty remaining about where it will all land.
Yeah, and how much does it get complicated as other countries watch what's happening in the U.S. court system? Adam, thank you so much for joining us. We really appreciate it. Bloomberg's Adam Blenford. And Cayla, it is remarkable just to look at the past week. We got 50% tariffs on the EU put on, then them walk back, a court ruling that the tariffs are illegal, and then a pause on that. I mean, how much do you just look at the latest machinations and say, it is just noise and I need to look through it? Or do you change your outlook as these different things pop up?
Yeah, there's a lot of whiplash, and you can only survive in whiplash for so long, I think, before you have to discount that this is just the environment. So one thing that we do is we actually track media sentiment and coverage of different topics and regress that against different markets, whether it's equities or the dollar. And so we can kind of track what topics are important for different assets. And it's interesting because for equities, when we look at coverage of trade, we still categorize it as important hype. It's still a key driver. But the R squared, or the strength of that relationship, is decreasing a little bit. And so I do wonder if, markets are starting to discount this a little bit. However, it's certainly, we're not in the clear, we're not out of the woods. And I would say and so it's just going to continue for a little while longer.
Yeah, great. We can worry about the budget or something else.
Yeah.
More concerns. Cayla, you're sticking with us. Thanks so much. You are watching Bloomberg Brief. Let's get you set up for your trading day on this Friday. More economic data, U.S. PCE, personal income and spending. That's at 8:30 a.m. Eastern. Then Trump holds a news conference with Elon Musk at 1:30 p.m. as Musk leaves Doge. The president is also expected to speak again around 5 p.m. That will be on the partnership announcement between Nippon Steel and U.S. Steel in Pennsylvania. And Cayla Seder of State Street is still with us. And Cayla, you were just telling us how the market's concentration on trade is still there, but it's starting to ebb. As the tax bill percolates, makes its way through Washington, is this the next risk for markets?
I think this is definitely the next topic that is going to be something that is front and center over the next couple of months, because there's just so much tied within this bill, and it has to get passed because the debt ceiling is part of it. So
how do you look, though, at this idea, just quickly, Cayla, if we're going to maybe have sand in the gears of the works of tariffs, less revenue, more deficits, is that a problem in itself?
That's definitely top of mind. Looking at the income that we got in April from tariffs, it's still a very small part of the overall pie. Tariff revenue accounted for something like 2% of overall revenues. So, if you are looking at tariffs as a source of fixing the deficit, that's going to be still a very high bar. And so if you are a deficit hawk, it doesn't look like these tariffs are really a solution to that. And so bringing it back to what's happening in terms of the reconciliation bill, funding, things like that, that's going to be a concern.
What a year we have ahead of us. And it's already felt like it was a decade.
Yeah.
Cayla, thank you so much for joining. We really appreciate, so generous with your time. Cayla Seder of State Street. All right, as we head to the end of the hour, a quick check on your markets. A little bit weaker, but not that much going on. S&P 500 futures down about 0.2%. It is a stronger dollar, snapping some multiple days of weakness. You're looking at U.S. 10-year yields, little change. But we did have the latest survey from Bank of America, the Flow Show, looking at data showing the biggest outflow of global equities so far of 2025. All right, that's it for your Bloomberg Brief. Surveillance takes things from here. This is Bloomberg.